Hi everyone, I'm Ricardo Gonçalves. Welcome to SBS On The Money from the SBS newsroom for this Friday, the 20th of November 2020. It's your daily 10-minute business and finance news wrap. Later, the Australian share market up nearly 11% in the month of November so far. What are the risks going forward? But first, to superannuation and retirement income, are there changes ahead, namely in the superannuation guarantee? The findings of a 10-month probe has been released by the federal government with three key points to be made, and here is the Treasurer, Josh Frydenberg, outlining them.
Australia's retirement income system is sound, is sustainable and is effective, and it's well placed to deal with the economic volatility as well as the ageing in our society. The report does not make any specific recommendations but makes a number of important observations. First, in relation to the age pension. The report finds that the age pension over the last decade has increased faster than inflation and faster than wages growth, and that the age pension has continued to reflect community standards. The second set of observations is around our superannuation system. It points out that people's early access to superannuation during the COVID crisis has been justified in that it sometimes is appropriate for people to access superannuation early, and that this hasn't had a significant impact on people's retirement incomes. In terms of the superannuation guarantee, as you know, it currently is at 9.5% and is legislated to go to 12% over time. The report looks at this in detail and makes the comment, and I'll quote it: maintaining the superannuation guarantee rate at 9.5% would allow for higher living standards in working life. Working life income for most people would be around 2% higher in the long run. A third set of observations is around home ownership. And the report points out how important home ownership is to people's security in retirement. It points out that around 76% of people over the age of 65 own their own home, and that as a consequence, this allows them to have more discretionary income, and it also provides an opportunity for them to draw down on the equity in their home in retirement.
The Treasurer there, Josh Frydenberg. So one of the key things here is the suggestion that the superannuation guarantee doesn't need to be lifted. So that's the superannuation contributions that your employer makes to your super fund. It currently stands at 9.5%. It's scheduled to rise to 10% on the 1st of July 2021, and then slowly lifting to 12% by the 1st of July 2025. But it seems like that's still on review. So for more, here is the ACTU President, Michelle O'Neill.
We're really concerned about the government not guaranteeing what is workers' legal right to see their superannuation start to increase again in July next year. The government went to the last election with this promise. It's in law, but they seem to be suggesting that they're going to wind that back. And of course, that's not in anybody's interest. These are the working people that have carried us through this pandemic, and they deserve to have certainty and dignity in their retirement.
ACTU President there, Michelle O'Neill. But what about small businesses? How do they feel? Here is the Australian Small Business and Family Enterprise Ombudsman, Kate Carnell.
It's really good news for small to medium businesses that the government has put off making a decision with regard to superannuation guarantee levy going up. Let's be fair, right at the moment, small businesses are doing it so tough that a message that the government was going to put up their costs, which is fundamentally what this does, it's just a new cost, a new wages cost for small businesses, I think would get in the way of confidence. I think what the government's doing, or hopefully what the government's doing, is putting off a decision till next May, when we will have a better understanding of where the economy's up to. And if the economy is still, in the position it's in at the moment, I hope that's a very good message to the government that really any increase in costs would be a problem.
Kay Carnell there, the Small Business Ombudsman. And finally, a lot of people don't like changes to superannuation and the status quo. Here is the Shadow Assistant Treasurer, Stephen Jones.
2 million Australian workers withdrew up to $20,000 from their retirement savings. If you're a 25-year-old, that's going to cost you about $100,000 in lost retirement savings. All the more reason why we need to stay the course on superannuation. If you axe superannuation now, you're going to be hitting those workers with a double whammy.
Stephen Jones there, the Shadow Assistant Treasurer. And the Federal Treasurer says any decision to delay any increases to the superannuation guarantee will be made in the May 2021 budget. To the Australian share market now, which traded sideways for much of the day, down by 0.1% only on the S&P ASX 200 to 6,539. But for the month, shares are up 10.3% just in November. And for the week, we're up about 2%, which is pretty decent, especially when you think back to just how interesting the week was, because the ASX shut the market early on Monday because of technical difficulties. For more on the day's actions, I spoke earlier with Luke Laretive, the CEO of Seneca Financial Solutions. Luke, the market's been trading sideways pretty much all day. Why?
Look, as far as I can see, Ricardo, there's a lot of dispersion in the market today. So whilst there's some stocks and the high quality stocks like Xero and CSL are doing quite well, there's some other stocks like the building materials sector and the energy sector that aren't doing well. So kind of on balance, we're going nowhere, but there's certainly some stocks moving.
Still, I guess shares have had a really solid start to November. What are the risks going forward, though? Because surely shares can't continue to climb as strongly as they have.
Look, I hope they do, but the market is up 11% this month, coming off a circa 300-point fall towards the end of October. I do think markets can move higher as virus concerns fade and the global economy continues to recover. But the short-term risks really are around this sort of slower than expected earnings recovery in stocks. Some of these sort of recovery stocks that people are buying are pricing in a fairly robust economic recovery. And if that doesn't eventuate, it might lead to a short-term correction in the markets.
And I guess that's where we're seeing this rotation from growth to value stocks. That's still happening. Yeah,
certainly still happening. And I think most professional money managers are kind of definitely looking that way. I would say, from my perspective, I think people shouldn't throw the baby out with the bathwater when it does come to quality growth stocks. I still think they're going to outperform over the longer term, but certainly valuation is becoming a little bit more in focus, and also the businesses that were perhaps just growing huge revenues but weren't really profitable, or we weren't really seeing that free cash flow fall through to the bottom line yet. They are probably being fairly harshly sold off across the market, as a general comment.
We saw retail sales rise 1.6% in October. How is that being reflected in the share market if those retailers, which have boomed, I guess, in terms of their shares during the pandemic, are now being switched out of?
Yeah, there's definitely a rotation inside the retail sector at the moment. Today, we're seeing great performance from some of the more typical retailers like Super Cheap Auto or Super Retail Group and JB Hi-Fi, while we're seeing stocks like Kogan, MyDeal, Redbubble, all of which have been beneficiaries from essentially working from home and lockdowns, sort of being sold off and being funding sources for some of the professional managers in the market. This tailwind of reopening hopefully is going to continue to drive, fairly good consumer spending. But as I said before, it's really a case of to what degree.
And speaking of retailers, Kogan and Accent Group, we saw a couple of AGMs today and strikes against their, remuneration reports. So what kind of messages are shareholders telling these companies?
Look, I think activism has been on the rise in places like the US for probably the better part of a decade. And I think it's only a matter of time before we see Australian shareholders starting to, take more aggressive engagement, I suppose, for lack of a better word, with their boards. And this is just two examples. I won't make a comment on the fairness or unfairness of those particular strikes, but I will say that in every aspect of life, we expect greater transparency than ever. We expect our voices to be heard. And I think really the corporate environment as a whole is probably lagging behind the rest of society.
Luke Laretive there from Seneca Financial Solutions. Finally, a quick one on property prices, because a rebound in consumer spending coupled with improved business investment and record low interest rates have seen NAB upgrade a raft of economic forecasts, and one of them is for property prices. It now expects property prices in 2020 across Australia to be up 1%. That's for the capital city average. For 2021 up 5%, and 2022 6.1%. So this big correction we were expecting because of COVID-19, we haven't seen values for the year. Next year, 2021, of the major capitals, it sees the best performer to be Brisbane, Adelaide and Hobart, up by 7.4%, Sydney 4.4% and Melbourne 3.6%. And in 2022, both Brisbane and Adelaide is likely to lead the market, according to NAB, with prices there expected to rise by 7.4% each. That is SBS On The Money for this Friday, the 20th of November 2020, and for the week. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.